What is up, YouTube? What is up, guys, and welcome to TCT Trading. That is a sick ass name if you ask me. Now, as many of you know by now, I have had a rebrand from just my regular name, Lars Koistra, to Decomposite Trader. Why Decomposite Trader? Well, we make our money based around entry models I've created that's based around Wyckoff. And Wyckoff himself, which is a man who created the original concepts, he referred to the market maker as the composite man. Well, since we know what the market makers are doing, that makes us the composite trader. So, this video, I'm going to be talking about Ethereum and its current range and how this range has developed. And if you want to have a practice range to see if you can apply all the advanced TCT schematics, this is the range to practice. So practice it yourself first. I'm talking about this range right here. Practice this range yourself first, and then come back to this video. See if you can apply all the advanced schematics yourself, and then come back to this video and see me and hear me talk about it. Okay. Also, the Wyckoff Model 1's distributions, accumulations, the Model 2's, they've all been renamed to TCT. And if you want to ask me questions on X regarding your taken trades and your setup, use the hashtag TCT. If you guys all use the hashtag TCT, not only can you see other people use it, where you can learn from, and you can see my reactions under their post in an organized fashion, because only people that use the hashtag get a reply, okay? That way, if you go to my Twitter, right, and you type in the hashtag TCT, you'll see all the posts of people using TCT, and you'll see my reactions underneath it, okay? Which is something you can also learn from, because I explain things to multiple people, and sometimes people ask the same things, which if you have checked my answers under other people's comments, which is now very easy to do, you can learn from that in a very good way. So if you guys trade using the concepts I have taught you in the Wyckoff tutorials, please just use the hashtag TCT. You can put it in your bio that you're a hashtag TCT trader, or just, if you make a post about, hey, I'm shorting here, using or applying hashtag TCT schematic model 2 or whatever you want to say. Just use the hashtag, okay? Very important. That's the only thing I'm asking from you guys. I've given you all the content. I've given you the concepts. There are more big things coming for everyone, for the public. Just use the hashtag TCT concept. Even if you don't have X, start making an account on X. It's a free speech platform. It's one of the only free speech platforms that are going to be remaining if it doesn't get banned by the government. But make an account on X and start using the hashtag TCT. That's the only thing I'm asking. So, having that said, I'm also working on logos and banners, by the way. Like, you're not going to keep seeing my body and face on the profile picture. It's going to all be looking extremely clean. Now, let's go into detail about this range, okay? And how this went from like a low time frame range to a higher time frame range to high time frame concepts to distribution into accumulations, vice versa. Okay. Now, Ethereum had a massive move down. Okay, Ethereum had a massive move down, and this was a key low. If we go on the weekly time frame, why was this a key low? Well, if we apply structure from literally the bear market low on the weekly time frame, applying the 6 candle rule taught in the tutorial, you can see that you have higher lows and higher highs, and then this was our low. Now, we have not broken the low, and this is something I absolutely do not want to happen. I do not want that low to be broken. So we wicked it in this aggressive flash crash during the volatility event, and from there, we had our relief bounce, which is something that always happens when you have a flash crash. You always get a relief bounce, but it's very key that you start breaking structure. So our most local structure from top to bottom, we have lower highs and lower lows, just like this. And this was a massive move down, making this on the 1 hour our market structure high. Okay, this was our market structure high. Now, it's very key that we break that high as our first signs of strength. Obviously, to get from this low up towards that high, we have some sort of bullish market structure from the low up. That's the only way we can get from point A to point B. Okay, so on the 4-hour time frame, I'm just checking the main pool here. We have a higher low and a higher high, just like this. Let's make that red. So red is a very important market structure pool, because if we break that pool, that will mean that our black market structure will continue itself with a lower high and a lower low. It's called just framing the chart using structure. Okay, now, as you guys know, that if we are trending up, we pull our range from top to bottom. So this is where our range started. You have your high. Let's make it red. You have your range high. You have your range low. Right here, you confirmed it. Okay, and now you have your range. So let's start zooming in on how this range developed. Okay, go on the 45-minute, make it all pretty, get rid of the market structure drawings. Always, you want to have a clean chart. There you go. So how this range developed, okay, is that you had some demand below the range low right here. How I'm pulling this demand is just these last two up candles that caused an expansion towards the upside, leaving an inefficiency, guys. You will always ask me, how do you pull order blocks, demand zones? I'm making a video that will go in depth about it, but I say the same things every time. I think I've pulled maybe 1,000 supply zones and demand zones on YouTube. 4 months of me just pulling multiple supply and demand zones each day. So you can figure it out, trust me. But an in-depth video about it is coming. So what happened? We had our range starting points. As you can see, we grinded up in the range, but we left massive sell side liquidity below. We never took the range high. We came down, sweeping all these lows right here, and then we deviated our range low coming into demand. Once you're deviating the low, immediate bells should start ringing of, hey, this can be a potential accumulation schematic, right? It can either be a model 1 or it can be a model 2, right? TCT model 2 or TCT model 1. Now, you know that, okay, if we had to guess if it's going to be a 1 or a 2, well, this deviation already grabbed all good looking demand on the left. Like, even this local demand zone right here, this order block, it also grabbed this one already. So most likely it's going to be some sort of model 2 if we get a TCT schematic model 2. Okay, but what happened is we came up. Yes, we swept some liquidity here. Some people called this a third tap, but if you want to call this a third tap, you have to really zoom in, because the distance between tab 2 and tab 3 is very narrow compared to tab 1 and tab 2. So if you want to call this a schematic, which the third tab did meet all the requirements for one, you have to realize that this range is way bigger than the 5-minute. So if I zoom out on the 1 hour, which is also a valid range, the third tab will just disappear. It will not be even structure. It will just be one move up that grabs some liquidity. And you have to realize, if that's the case, price can easily come back down all the way for this to be a higher time frame third tap, because on the higher time frame, this is just a second tap and not a tap 2 and a tap 3. So we got a deviation, we came up, but we never came down before tapping the range high to confirm some sort of, mid to high time frame TCT schematic. So that idea is out of the window. Now we start deviating the high. Right here, we just had equal highs, so that doesn't count. Again, guys, equal highs do not count. And then we got our deviation 1, okay? Indicating that now we have the chance of this becoming an accumulation, and we have the chance of this becoming a distribution, right? Because we have a deviation at the low, and we have a deviation at the high. But we know that this is a key area on the chart that we need to break, okay? So after the deviations, we extend our high, and we can extend our low to the new deviation low and a new deviation high. And then if you were patient, you have to realize, okay, where is my extreme liquidity? Okay, where is my extreme liquidity? It's right around here. Take that as our extreme liquidity. It's probably just your first market structure pool, as always, from top to bottom. There you go. From top to bottom, you have lower highs and lower lows. That's your first pool, making it your extreme liquidity. Again, guys, listen to what I'm saying. You guys have been asking about extreme liquidity. I'm giving you hints here prior to making an in-depth video. But yeah, it could be a Model 2. You also have supply right here. So you have to be aware of a potential Model 2. But the Model 2 never got confirmed, okay? The Model 2 never got confirmed. Because if you pull your structure from high to low, you never broke it back to bearish. You never broke it back to bearish. Even here, you wicked it. A wick is not a break, okay? A wick is not a break. So once you took this high again, that immediately invalidated the idea of this becoming a Model 2, and then you had to move up again, and you simply just had to wait for structure to break back to bearish. Boom. Right here, you got that candle close below it. That is your short trigger, and then that's your stop loss, and then the target obviously is all the way towards the range low, okay? Now, it's very key that you realize, yes, this is a high time frame distribution, grabbing on that third tab liquidity on the left, failing to break that high, which is bearish, but you also had a deviation at the lows. What does that mean? Well, that means that this distribution can go over into an accumulation. So you cannot target the official range low because it can go over in the Model 2 accumulation schematic, Model 2 TCT schematic, right? So now we have to realize and we have to analyze where is our extreme demand and where is our extreme liquidity from an accumulation perspective. Now, let's zoom in, and then right here, I'm just going to keep it very simple for you guys. You can use this candle as your demand zone. Why? This candle grabbed liquidity on the left, closed back to bullish, left an inefficiency behind that got partially filled here before moving higher. On the low time frame, this is probably an official order block because it's a different candle color. But yeah, right here you can say, hey, this is my 10-minute order block, which is also fine, but it's in the same area. Both would be good enough for me, okay? So once we come right here, we even took the liquidity from the block, even grabbing your extreme liquidity point. So you tapped your extreme demand and you grabbed your extreme liquidity point, meaning it validates the Model 2 idea. Now we just have to wait for structure to break back to bullish. So if we follow structure, our most local structure, you have a lower high and a lower low. And that's where you took the low, and this is where you broke the high. Break of structure. So right here could be your long for the Model 2 accumulation schematic. Now, what is very important, okay, what is very important is that compared to the distribution schematic, where you're entered right here, you only had lows here. You had this liquidity low, this liquidity low, this liquidity low, this low, this low, this low. You had an amazing liquidity trail below you and no support, meaning that the move down will be smooth. You can see right here, aggressive move down, horizontal price action, gather some more liquidity, aggressive move down, because there was nothing to hold price up. But now, right, now that you have the potential accumulation schematic, you actually have resistance because all these moves consist of supply. So that is what makes the accumulation schematic way less attractive, because you have so many supply zones to pass through in order to get to your target, okay? In order to get to your target. Now, it did end up coming all the way back up towards that high. So it did work. It would have been a massive swing trade. And it's not something I like to do per se. The only thing that I did is, with my position that I had running on this short, I hedged it right here. And I kept that hedge open. So I got stopped at break even on the move up, right? On the remaining of the position of the short. And I had 25% open. And that 25% I hedged right here. It's a little advanced trading trick for, once you start understanding how these concepts work to the T. but that's what I did, okay? Because I don't like to long when you have so much supply above and you have a distribution above. Because listen to me closely. We know that TCT models can flow over into each other. A model 1 can flow over into a model 2. That's also something I've been talking about. Models flowing over into each other. So you left behind a very good supply zone right here. So what could happen is this model 2 could never hit its target, and the sole purpose was to hit this supply zone to become a bigger 1, 2, 3. Okay? 1, 2, 3. Model 1 flowing over into a macro model 2, an extended TCT schematic, right? So that's something you need to be aware of. Now, it ended up smashing absolutely through it, having no structure break back to bearish in this move up. So there's no way you could have gotten trapped in here. Okay, no way you could have gotten trapped in there. Now, what's actually pretty funny, now that we know we have the distribution and we know we have the accumulation, so we're kind of sandwiched, within the range, if we follow structure from the low up, we have highs and lows, just like this, highs and lows. If we follow structure from the low up, we also had a range, and even here, we had a potential distribution and a potential accumulation, because we had a range within a range, which is very common, guys. A range within a range happens all the time, especially if you have a macro range. They will always have some sort of ranges in the meantime. Let me clear this up, make this all clean. There you go. So we were really sandwiched in between accumulations and distributions, okay? Really, really, really sandwiched. Now, what ended up happening is we got the deviation at the high, we got the deviation at the low, indicating that both could be in play. But then right here, if we extend it towards our range low and we extend it towards our range high, our new range highs, you saw that we got the third tap right here, and that grabbed even that liquidity point right here, which was around our entry. And then I got my stop below the low, so nothing to worry about. But right there, you had your accumulation model 1 schematic. And why this is actually a nice schematic is because if we look above us, what is going to hold price down? Okay, what is going to hold price down? Right here, we simply have one supply zone, okay, one little order block. And prior to that, we have inefficiency. And above that, we have liquidity, okay? And that's why you can see this pop here. It's just a liquidity pop from the liquidity on the left, okay? So that's what made the accumulation actually pretty nice, because even if this was going to flow over into a distribution, it needed to grab the extreme liquidity point, which was literally like all the way up here, right? All the way up here. So see the difference between this accumulation and this accumulation? This one had resistance right above us. Oh, this one had the resistance right above us, and the other one didn't. 1 second, guys. Potential trade alert. No, didn't get the entry on it. Okay, all good. So we even had an accumulation inside of a bigger accumulation. So that already indicates that, hey, we have two accumulations within accumulations, and we have one distribution. Okay, so probably we can get some follow through. We can get some follow through here. Now, let's delete this because this ended up hitting its target, and we got smashed absolutely through that supply zone. Now we have to reassess because, hey, now we took the high again. Is this going to be a 4 tap? Huh? We can have it. We can't have a TCT schematic that has 4 taps. Well, now we need to analyze what is the highest time frame that our range is valid. Okay, what is the highest time frame that our range is valid? So if we delete all these tabs, and we delete all the tabs right here, we have to apply the 6 candle rule. Okay, we have to apply the 6 candle rule. So is this an 18-hour range? Is this an 18-hour range? If we move up, is this an 18-hour range? No. Why? Because we never had 2 consecutive candles in the pullback prior to taking the high again. On the 12-hour, we did. You can see them right here. 1, 2. Those were your 2 consecutive candles. Did we have 2 consecutive candles in the up move, taking the high? Yes, we have. Right here. 2 up candles. Was this a model 1 on the 12 hour? No, because we never had the 6 candle rule between deviation 2 and deviation, or tab 2 and tab 3, which we did have on the 4 hour. So on the 4 hour, yes, this was a TCT model 1 distribution schematic. But on the 12 hour, it's just one move up. Okay, on the 12 hour, it's just one move up, just like this, making this still the same range starting points, but this is deviation 1, or that's tab 1, and this is tab 2. So now if we extend it, we can come back up, take that high again on the 12 hour, and still become a valid model 1. It's just a high time frame model 1, where, you know, the low time frame, which is equal to the 4 hour, went over into the high time frame, equal to the 12 hour. So yes, it could still be a distribution schematic, completely valid. Okay? Now, I would have preferred if we had a bit of a deeper deviation tapping into that supply, because then we could say that that deviation actually had a reason. Yes, it took that high one more time, which is just a good liquidity grab, but I would have preferred this to have like a more like a buy to sell in here. That will be crazy, but we didn't get that, but that's still fine. Okay, it's not a requirement to trade the schematic. We know, okay, when do we confirm a distribution? If we break structure from the low up. And for the structure from the low up is we actually took that low. So you have that high, you have the low here, boom, making this your market structure low. There you go. We SFP'd it first, and we kind of SFP'd it the entire way down. Never truly breaking it, which would be annoying if you didn't understand Wyckoff within Wyckoff, okay? Because you kind of wicked it the entire time. So you never really broke it right until here. But then that's already when you're pretty late, because the invalidation of the Wyckoff is that third tab high. So if you enter here with your stop loss all the way up there, you only have a 1.5 risk to reward, which is nothing, okay? So this is where Wyckoff and Wyckoff plays a crucial role. Because what can you see if we follow structure like I just did from the low up? We have higher lows and higher highs. And you know by now that in an uptrend, we pull our range from top to bottom. So let me keep that range there. This is the original range. And as you know, we had ranges in the middle of the range, but we can also have ranges in ranges at the highs of the range. Okay? So right here, if we delete all these lines as well, keep it clean, keep it clear. We had a high, we had our low, and then boom, we have our range. There you go. We have our range. And this is our range high. That's our range low. I gotta sneeze. Oh. Thank you guys. Bless you too. This is our range high. This is our range low. And now we can start to look for another Wyckoff, right? Because we can have, mind you, we can have Wyckoff within Wyckoff. Now, what I mean with Wyckoff within Wyckoff, yes, technically speaking, this was also Wyckoff within a bigger Wyckoff range. But when I refer to Wyckoff within Wyckoff, I refer to a certain tab having Wyckoff. So your tab 1 having its own little Wyckoff schematic, or your tab 2, or in this case, your tab 3. Because if your tab 3 has a Wyckoff schematic, you can trade this local Wyckoff schematic and just wait if it breaks, and then you already have an amazing entry for the bigger Wyckoff schematic, okay? So we're going to use these dots, and we're going to make them blue, so you know the difference in the Wyckoff schematics that I'm referring to. Let's make them all blue. There you go. Make them all blue. So now we know, okay, we have our range high, we have our range low, we have deviation 1. Hey, that already indicates that we could have a potential TCT distribution schematic in the making, okay? Now we just need to see, is it going to be a model 1 or is it going to be a model 2? Okay, well, let's check our structure and let's check what our requirements are. So checking for our extreme supply zone, I can already tell you that this right here is our extreme supply zone, okay? And you can technically take the entire move. Let me see on the 5. Let me see on the 2. Yeah, you can take this entire move. You can even see it was a little supply chain. So you had this supply, creating that supply, leaving an inefficiency below. You came back in there. That's your extreme supply zone. So at the moment of this tap, the TCT Model 2 schematic has met all its requirements. Now you just need to wait to confirm it, and if it's even gonna get confirmed. Well, you just wait for the most local structure, which is this high and higher low, and then boom. That's your break of structure. So right here, right here on this break, you could have shorted this local Model 2 schematic, and you could have targeted all the way down. What was there to hold price up again? Nothing. Absolutely nothing, making it a better schematic because you have no support. If you have no support and you just have liquidity, it's always a better schematic, okay? Because you have no support to fight through. So this was an amazing, amazing trade. But look at the V-shaped recovery from it, right? You came back up all the way after failing to break your range low. So this is most likely not going to be that break we were hoping for to complete the bigger Wyckoff schematic on the 12-hour, where this is your tab 1, that's your tab 2, and that's an equal tab 3, right? It's a tab 3 of this local schematic right here, and it's a tab 3 of the bigger schematic. Now, we know, again, just like I said right here on this schematic, where tab 2 and tab 3 are pretty close compared to tab 1 and tab 2, you had the same right here. You had the same right here. Let me delete all of this. Let's make these equal. Let's extend this. And let's get rid of that tab. Okay, there you go. So we know now this could turn into a potential accumulation schematic, okay, because you failed to break that low. And we know that distributions can go over into accumulations. But we also know, and we also need to check, okay, what's the highest time frame that this range is valid? Well, using the 6 candle rule, we can pull market structure like this very easily. Can we do it on the 2-hour? We can do it on the 2-hour. No, 2 hours inside bar candle. So it's on the 1 hour, okay? On the 1 hour, it's valid. On the 2 hour, yes, you have consecutive candles coming down, but they're all inside bar. This candle is in between the highs and lows of the previous one. Same goes for that second candle, making it not valid. But on the 1 hour, it is. It's a 1 hour range. Guys, this is not a tab 2 and a tab 3 on the 1 hour. So on the 1 hour, this is just one move up. Okay, this is one move up. So we know that, hey, this local TCT Model 2 schematic could go over in a high time frame TCT Model 2 schematic. Now we need to check, okay, where is our supply? Well, prior to breaking structure, this was our extreme supply zone right here. Now, this becomes our new supply zone. There's nothing higher because, as we just discussed, we got that tiny mitigation there, so you can just pull it up and still call this unmitigated demand or supply. And that's our requirement for our macro third tap. So we know, okay, this local distribution can go over into a higher distribution, but we also know it can go over into an accumulation. But if we trade the accumulation, we cannot particularly target that range high because it can go over into a bigger distribution, okay? If I'm going too fast, guys, really just slow it down and really listen to what I'm saying. So we have the local Model 2 TCT schematic. It can go over into an accumulation Model 1 or Model 2 schematic, okay? But we know we cannot target the high, per se, on this TCT Model 2 schematic at the bottom because it can go over into a bigger Model 2 TCT schematic, because we're still fighting a potential macro Model 1 distribution. So what you could have done right here is check, okay, what's my extreme liquidity? I would even argue that this was already your extreme liquidity. On the lower time frame, that's just your first market structure pull, as discussed earlier. Now you just need to wait for structure to break back the bullish, which was right here, okay? So right here it failed. This is still SFPs. You failed to come above that high. But then right here, you got those closes above, okay? So following structure, you kind of failed to do it right here. Here you broke it, and you could have just find a long on any of this retrace move, okay? Any of that retrace move, just have to see, was there like demand that needed to be mitigated? No, not per se. Okay, you could have just, entered long if you wanted to, kept your stop below an internal low, because if it goes there, we'll probably visit that low again, and then target up towards that supply zone high and see what happens from there, okay? And that was an amazing trade. But we know we cannot particularly target here because it can go over into a bigger distribution since the macro context is pointing more down, okay? Now we need to wait, okay, When do we confirm this distribution? Well, obviously, if we break structure, our most local structure from the low up, again here, higher lows and higher highs, applying the 6 candle rule. Right here, you got your break, boom, break of structure. And then right here, you had your only supply zone remaining. That's where I would have shorted because it was an obvious supply zone. They don't leave obvious supply zones like these behind. Look at the timing again, guys. Look at the timing. You tap the supply on Sunday night, and on Monday open, you dump down. I've been talking about this, that trades late during Sunday, and then Sunday night, Monday open, they manipulate price insanely. So this could have been your short. Are we targeting the range low? Well, not per se, because we already had a Model 2 accumulation schematic that failed once we broke this, confirming the bigger distribution schematic. No, we're not going to target the range low. There's nothing to hold price up here. There's liquidity here, there's inefficiency here, and then we know if we break the range low, we can have a insane Model 1 distribution schematic, and that's why we target all the way down to here. Okay? That's the trade, guys. A 20 or a 19 risk to reward setup. And that's the trade I still have open. And it's just a trade that runs in the background the entire week, covering up any loss that you take. And it's amazing. Obviously, I took TPs along the way, and I have a runner for all the way down here. So you can kind of make it like 10 to 11 risk to reward. But it's a trade that, if it hits, and trust me, guys, this is most likely going to hit because there's nothing here to hold price up but liquidity. Again, having that nice, return to zone I always talk about. It's an amazing trade that runs in the background. But you could have only traded this if you fully mastered the TCT concept that I've been teaching in the tutorials on YouTube. Part 1, but especially Part 2, because that goes into the advanced schematics. So we had a Model 1 distribution that went over into a Model 2 accumulation that had a Wyckoff and a TCT schematic inside of the range that pumped higher for a higher time frame Model 1 distribution, where that third tap had its own local distribution that went over into a local accumulation that went over into a higher time frame distribution within the same range, and then we broke it, confirming the macro distribution. So it sounds insane, but this is how markets move, and this is also how they extend ranges. Having a local Wyckoff schematic and a local TCT schematic that goes over into higher time frame schematics by deviations to the upside and the downside. That's how they extend ranges and create bigger ranges. So this is an insane video and an insane example of a range that you want to practice over and over again and see if you fully understand it and can explain every move within this range. Because every move within this range is explainable, literally. I've just done it, so after watching my video, go and try and do it yourself as well. And if you have any questions, you leave them below in the comment. I love you guys. We're starting a new momentum wave of new concepts. It's no ICT anymore. It's TCT. ICT has all my respect. He has helped millions of people. He's an insane mentor, but he doesn't trade like this. And this is truly unique. Okay? So, TCT. Use the hashtag. I love you guys, and peace